Good afternoon, everyone. Thank you very much for attending this webinar this afternoon. For those of you listening live, we do appreciate you taking the time to do this. And for those of you listening to this on playback, it's Thursday, the 18th of May. For those of you that are not familiar with me, my name is Nick Lambert, and I'm the Managing Director of Alpha Wealth. And I'm joined by a couple of my colleagues. For those of you that have listened to any of the previous webinars, you're probably familiar with Donahue, who's head of our business development, and Keenan Cunningham, who's head of our marketing department. And we're going to spend the next 25 minutes or so just going through a little bit on basically for senior managers and business owners, some rules that have changed and how to best manage, I suppose, your financial position. My colleague Keenan is going to throw up a poll just to kind of get people, I suppose, thinking about tax, which is one of the key themes for today. And I'm going to talk later about our last of the webinars before kind of the summer breakup, which is basically given by David Looney. And he's going to talk a little bit more about tax beneficial schemes. And I'm going to give you a little bit more information on that. So thank you very much for filling in the questionnaire, or I should say, and I'll just get started with it. I'm conscious that there are people who have heard us before, but for those of you that haven't, Alpha Wealth is a progressive financial services company. We're going into our 10th anniversary next year, and there's currently 9 qualified individuals giving professional advice to individuals like yourselves. The main theme of today really is about what has changed in the pensions landscape and why it really is important to understand what those changes are. And then secondly, I'm going to kind of talk about financial independence and how to achieve it. Now, again, really the main theme of what I'm trying to do today is for, regardless of what stage you are in your financial cycle, help you understand and navigate the different opportunities, I suppose, and risks that are out there in terms of what can benefit you going forward. Please do feel free to put any questions into the Q&A. We do try to make these as interactive as possible. You can do so anonymously if you prefer. And my colleague Cleena has some questions that we've received, which she will go through during this presentation. So basically, since the 1st of January this year, there's been a change, and it's been a significant one in the pensions environment, where for business owners or for senior managers who have the ability to have negotiations around salary versus pension contribution, there are no limits to how much money can be paid into a pension scheme by your employer, subject to the current maximum pension scheme that you can have, which is 2.15 million euros. And that may seem like an extreme figure to some people. Funny enough, I met somebody earlier who worked for Johnson & Johnson who had received a letter recently saying that they were basically projected to exceed that figure. They were only in their mid-50s, and that any future contributions into their pension were going to go into a savings account. Now, it's a really nice situation to be in, of course, but I suppose the key point I'm trying to make here is that it's really important to understand about what your pension can do for you, where you are now, and more importantly is how you can basically build up that pension as quickly as possible, especially given the fact that there's great opportunity for you to put money into a pension, not only yourself, but obviously your employer. And I'm just going to emphasize this point in an example. Now, obviously, there's many of us that won't get anywhere near 2.15 million, and that is the absolute maximum. There is absolutely no point anybody exceeding that. But to put it in context, The pension maximum in England is 1.08 million. So it shows you that there's a very generous allowance given to Irish employees. And I suppose really, if you're in a financial position to do this, my advice is try and build up your pension quickly. If you can get your employer to help you, especially by way of bonuses, or if you own a business, there is a really, really generous opportunity now since the 1st of January 23, where you could take a low salary and have a very, very high pension contribution going in. Okay. And again, please feel free to ask me. Give you one very quick takeaway. If you're a business owner, like myself, for example, and if you have children who are over the age of 14, you can start paying significant amounts into a pension for them. That's an opportunity for you to consider, and we can discuss that further with you, of course. Okay, so this example, it's actually a real example of a client that I met not too long ago. I've changed the names, obviously, for the illustration. 35 years old, earning 80,000 plus basic plus a 20,000 bonus a year. And they were essentially paying tax, which was netting their 80,000 gross to about 53,000. Their bonus, they were paying 52% on, of course. They were earning over 40,000 a year. So essentially, for a 100,000 package, they were only seeing 66,000 of that. They were making a pension provision of 5% of their salary, and their employer was doing the same. However, if they had the ability to reduce their basic by 10,000 euros and to put that money instead into their pension, so obviously their basic now becomes 70, which would net them 48,353. And if anyone's wondering where I get these net figures from, there's a really good calculator on a couple of different sites. Deloitte have a good one, as do Ernst & Young. We can forward it on to you after the webinar. For anyone who's interested, please feel free to reach out to us, nick@alphawealth.ie, and I'll send you this, and it'll show you how much tax you should be paying, whether you're paying too much tax, and it's always worthwhile exercise checking in on. But again, just to illustrate this example, for anyone earning 70,000 gross, you typically would net about 48,300 odd. And if you had the ability to pay more into your pension and also put some of your bonus into your pension, and the illustration given here is instead of putting 20,000 bonus, 10 of it you get, 10 of it goes to your pension. Your total package now increases up to 76,000 euros. You will earn 53,000 in physical money, and the balance of that will go into a pension contribution.
And Nick, what if a company, what if a company won't make payment into a pension from the bonus?
And again, that could well be the case. You know, the thing is, firstly, to ask, and obviously, as hopefully you get higher up the company, you may have the ability to negotiate with them. And the reason why it's beneficial, not just to you, but to your company, is that as this illustration shows, companies that pay a salary to their employees must pay employers' PRSI, which is about 11%. So for anyone who gets a salary increase of 1,000 euros, they obviously only see 48% of that, which is 480 euros for the 1,000. The company pays basically around 1,100 euros because they have to pay PRSI. If the payment goes into a pension, the company gets tax relief on that contribution, and they don't pay employees PRSI. So the company benefits, as does the employee. And because of these change of rules since the 1st of January, Revenue are taking a much broader approach with employees. I've dealt with many senior managers over the last number of years, one of which had deferred bonuses, and they were worried about the amount of tax they were going to suffer when they drew them down. Because their contract of employment allowed for bonus payments to be paid in the form of pension, which can be amended, by the way, and we've done this for people. The only thing is your employment contract needs to allow for that, and that can be revised. Their company can then make payments into their pension scheme. It really, really is a powerful mechanism to reduce the tax you pay. And as I said, we're happy to give you some guidance and assistance with this. Alpha Wealth operate as an independent broker. And you can see there on the early example, it can make a significant difference as well as obviously helping your employer reduce the amount of money that it costs them. And in this environment, paying more money into a pension scheme, obviously to them would make more sense. Just to move on from that, I just want to explain a little bit more about something we've talked about called financial independence. And for anyone who's watched some of our recent webinars, and we are going to be doing one last webinar next week, which I mentioned, which I'm going to talk about briefly in a second. My colleague Keenan's going to put up a link into the chat where you can access our webinars completely free. They're typically 30 minutes each, and they're focused on different areas. One of them I did recently about how to save 30,000 over 4 years was a really good one. I would suggest for anyone who is looking to build money up, either for purchase of a property, for an extension they may want to do in the future, for a new car, for kids, for a third level education and so on. Doesn't have to be over 4 years, of course. That was just a specific example I've used in that particular webinar. But basically for financial independence, what we're saying is that we're helping all of our clients understand that regardless of what stage you are in your life, whether you're in your 20s, 50s, 70s, to get to a point where you know that you don't have to work physically to ensure that you can survive. What I mean by that is that you have more income, passive income as I call it, where you don't have to work, that outsees your expenses. You have no debt, especially given the fact that mortgage rates have increased so significantly. Paying down a tracker in this environment, to me, makes complete sense. About 6 months ago, it made no sense at all. As well as that, covering any future expenses. So for example, if you have money in the bank, and obviously, you know, looking at your overall financial objectives, and I talk about this menu board, the key thing to understand is what is the opportunity cost? What can you do with that money that might be better placed? Is it to reduce down the cost of the debt you have? Is it to invest it in more tax efficient instruments like your pension? Is it to put it into a fund where you can access it, but isn't earning 0% in the bank? And again, this is our role as independent advisors in helping you find the right balance. When I talk about long-term planning, and I talk about compartmentalizing between short, medium, long-term, again, just to reiterate, short-term is anything less than 3 years, medium-term is 3 years to your retirement, financial independence age, which for most people we work with, we generally recommend 60, if not earlier. And again, this is about understanding how you can put yourself in a position where you don't have to work. We talk about this phased retirement approach where we help clients understand different pension pots may suit you, and they may have come from different employments to allow you this ability to not have to work full time or work less hours or do something that you prefer that may pay less. The sweet spot of pensions that I speak about is between 600,000 and 800,000. So anyone who says, "Oh, I don't really understand pensions, I don't really know what I'm aiming for," I would say to you, regardless of your situation, if you can show, or more importantly, is if a financial advisor like Alpha Wealth can show you that based on your current projection, you will have 600,000 in today's money at the time that you are looking to take life easier or to stop working, that should succeed. Specifically, let's say you were 60 years of age today, and let's say you achieved the 600,000. And again, in today's money, we show our clients projections. I'm going to show you my own in a second. That would allow you to take out 150,000 tax-free, which is 25% of that fund. The 450,000 that remains would allow you to draw very conservatively 22,500. Now, typically it will be more than that. Again, I'm taking a very, very conservative stance here. And on top of the state pension, which kicks in at 66 years of age, of course, currently, that will give you an amount of about 36,000. 800,000 in your pension pot brings those figures up. And again, we can help you understand your own scenario. And it is very specific to the individual. There is no one fits all. We have clients who have exceeded that. We have clients who are not going to get anywhere near that. Depending on their circumstances, they may have a partner, obviously, which does have a bearing, of course. And this is why we like to talk to people in a joint situation together or separately. But it's important for them to both have a bearing as to where they stand. In terms of my own roadmap, as I call it, I am 49 years of age. I am looking at basically getting to a stage of 63, and it needs to be reviewed because things change. My life has changed very much over the last 20 plus years. I went from working in the UK to Ireland. And anyone who has worked in the UK for 3 years or more, I keep saying to them, and you have up until the 31st of July 2023 to buy back up to 17 state UK pension years, and we can help you with that. But it's about understanding where you are today. My current pension is worth about 220,000, and at the moment, with projections and contributions that are being made into my scheme of €1,000 a month gross, costing me 600 personally, I am projected to have a fund of about €770,000, which in today's terms is 509,000. A little bit short on the figure that I spoke about earlier, but in my own personal situation, because I have a company, I'm allowing for the fact that I believe there will be some value in that, which is going to make up that shortfall. Again, please feel free to ask any questions, guys, and we would like to maybe address anything. But what we're saying here is we're trying to show you how you can make sure that you get your money working for you. The example now I've thrown up on the screen is around savings. And I believe all of us have the capacity to save. You may be in a situation where you find that you have less money every month than you earn. And let us help you understand about how we can reorganize your finances and put you into a position where you can save first. You know, I talk about what I call reframing, and I believe all of us should be in a position where we can save at least €100 a month for the purposes of things that we need to do in the future, whether it's to do works to a home, buy a new car, plan for a wedding, plan for kids to level, and so on. Specifically, we show people the best account to do that with. The example I use here is through Zurich. They have an account called the Easy Access Saver. It is by far the best of its type. We recommend that as an independent broker. We have no affiliation or bias to them. We show you the difference between their funds versus the market. They've typically outperformed. And we offer them to our clients at the lowest fees possible. This chart that I've just put up, guys, is really, really important for anyone who has money, whether you're putting your money into a pension, into these medium-term savings. It's an understanding of risk and reward. A lot of people who we come across may have money sitting in the bank or the post office or credit union. That typically sits on a risk profile 1, of that scale of 1 to 7, where you earn no money, unfortunately, at the moment, and that's not going to change anytime soon. Despite higher interest rates, deposit rates are not going to follow, primarily because of the fact that KBC and Ulster Bank left, leaving a large amount of deposit money to go to the rest of the banks. And then on the other side of the scale, you've got very high risk. And our role is to find the right balance. Generally speaking,
Nick, can I interrupt you there and just ask you what is the difference between these and investing then maybe in something like ETF?
Okay, so for anyone who doesn't know what an ETF is an exchange traded fund. Some people may have had experience where they've set up a stockbroking account and they bought shares or funds. An ETF is just basically a fund where you might want to expose yourself to the 500 top companies in the US. This is the S&P 500, and you can buy what's called an ETF to do that. Difference basically is buying ETFs generally tend to be where there's no management of those. They're passive, as I call them. You're basically exposed to a fund and you benefit or you lose out based on that. The difference between that and Zurich are active managers. And as I said, they're the best in class. They will make investment decisions based on where they see growth, whether it be in equities, bonds, alternatives, and so on. And more importantly is that it helps you understand about the flexibility and diversification it provides, where you can change the risk level. This is where we help our clients. We manage these accounts for our clients. You have no direct dealings with Zurich. You have access to an online portal, and we make sure that we keep fees to an absolute minimum. They're easier from a tax perspective as well. You don't need to worry about tax declarations. There's a lot, I suppose, involved in things like ETFs and so on. And I would warn anyone who has bought ETFs or shares for that matter, that they may not necessarily be using the right tax treatment. Sometimes they're capital gains, sometimes they can be taxed at income tax levels. And it's just important to know But this account really works very well. And what we do is we show projections to our clients over the time frame they're interested in, whether it be 3 years, 5 years, 15 years, and so on, and how contributions that can grow on a sustained level. So, for example, for most of our clients who are saving over 5 to 10 years, typically we would recommend this profile 4, where you're looking at returns of between 5 and 10% per annum. If you're looking at pension funds, so for example, anyone who's working for a company and you have a pension fund, if you're in your 30s, you should be up around the risk level 5 and 6. Why? Because you have a longer term, and therefore you should be prone to take a little bit more risk with a view for the accelerated returns it can offer you. And obviously, again, we'll offer you advice in relation to how that should be managed.
And Nick, just before you move on there, a question has just come in. Can you just tell us over how many years are returns generated?
The returns are generated from day one onwards. So typically these funds, you buy in units and you can see how they perform on any given day. Our advice always, if anyone is getting into this type of account, is to give it 3 years or more. You're not tied into that. As I said earlier, there's no exit penalties and there's also no entry fees through Alpha Wealth. So if you put in 100 a month, if you put in 10,000, if you put in 1,000 a month, you will not suffer any costs of entering, and you can leave on your own volition. But we would always recommend 3 years plus because we want people to benefit from the compounding that the accounts offer. Einstein spoke about this, and I keep going on about this, that the theory of compound interest is so powerful. If you earn 3% a year over 10 years versus 1% a year over 10 years, you're more than double the returns that you'll get in terms of, like, it will turn your money and it will give you a more than double the effect. Even though there's only a 2% differential, it's enormous. And again, I would really emphasize to anyone, especially if you're saving for longer term things like kids' education, it's an absolute no-brainer. In relation to, I suppose, the next area I'd like to touch on, in conjunction with pensions, and I talk about a menu board, the 3 things that I think everyone should consider is, how can I reduce the tax I pay? If I'm in a position where I can get my company to pay into my pension, that is definitely the best option to take before salary. The next thing then is to say, okay, can I pay into my pension? And there are some very generous limits that allows you to make considerable contributions into your pension scheme. And sorry, I was just going to throw up a table there. You can pay, depending on your age, up to 35% of your salary into your pension. If you're in your 40s, it's 25%. Early 50s, 30%, late 50s, 35%. Hugely generous limits. A lot of people think that they can only pay in 5% of their contribution because that's what their employer does. That is absolutely not correct. In relation to the next account on this menu board, the scheme that I'm going to talk about briefly is called the Employment Investment Incentive Scheme, or more commonly the EIIS scheme. My colleague David Looney is doing a webinar on this next Tuesday at 1 p.m. I'm going to give you some details of it in a second. There's a recent webinar video that Keenan's put up a link for where we talk about specific companies. I'm going to touch on 2 today with you. And really what I'm trying to give you guidance of is for personal investment monies that you have sitting in the bank, it makes complete sense if you're earning over 40,000 a year to consider investing your money over a 4 to 5 year period, because the fact is that if you do invest that money in a qualifying company, it's about 50 to 70 every year that look for this finance, the Irish government will give you back 40% of your investment amount with a view that at the end of 4 to 5 years, you get your money back plus interest. There is risk in this scheme. However, it's really worthwhile understanding the opportunity and obviously having a look at the companies and making sure that you feel comfortable with the advice and with the companies that are being recommended. The specifics of this very quickly are, if you say, for example, put in 10,000, and again, this is for last year, equally qualifies for this year. Earlier this year, you would have received back 4,000 euros from revenue. At the end of the 5th year, and I'm going to err on the 5th year as opposed to the 4th, and that's on the discretion of the company, you would expect your 10,000 back plus approximately about 28% interest. Obviously, if you do the math, that's more than 100% return. Now, the risk is that the company doesn't pay you back your money after 4 to 5 years. And obviously, you have to understand the fact this goes back to this risk reward that we spoke about. but getting that 40% rebate, immediately, which is a 66% gain if you think about it. 6,000 becoming 10 is a 66% gain. It's enormous, and it's definitely worthwhile considering. Two companies I'm going to talk very briefly about. One of them is called Blacks of Kinsale. It's a fantastic company run by very progressive owners, Sam and Maudley Black, who are on the screen there. Turned over 2.1 million in 2020 and 21 from 990,000 in 19. They did extremely well through COVID, and they are currently finishing off a multi-distillery plant in Kinsale that's going to give them the opportunity to further growth abroad. And this is a company that is currently raising money for this site. We can send you on information this, or as I said, there is details of a webinar that we recently did, which Keenan's put up onto our link there in the chat, or indeed, please listen to David Looney, my colleague, who's going to talk about this opportunity next Tuesday, the 23rd of May. The second opportunity is run by a company called Clyster. Basically, they bought a restaurant in Cork, just outside Middleton, called the 2 Mile Inn, for anyone who's familiar with East Cork. And they're going to renovate this property. They spent about 500,000 to buy the property, and they're going to develop it by spending a further 1.5 million, of which you can have security of the property. And once they obviously have it back trading, they're looking to provide an opportunity to investors. They're a really, really good company, and if anyone wants more information on that, as I said, we're more than happy to share that with you.
So Nick, just on the EIS, or do you want to kind of continue on this slide, but can you just kind of maybe provide a little bit of detail on the difference between maybe investing in EIS and investing in your pension?
I really prefer for people to invest ideally monthly into their pension scheme. So if you're an employee, you pay the maximum ADCs, and obviously if you've got the opportunity to get your company to pay more in due, you can go back 1 year, by the way. So anyone who did not maximize their pension contribution for last year, personally, if you had money, my advice is to do that. You have until about the 14th of November this year to do so. Where EIS works well is if you have a lump sum in the bank. And it's an opportunity over 4 to 5 years to make an investment and to get that tax relief quite early. But it's about a blend, and I keep saying the same thing, and you're going to get sick of me saying this. Our role in Alpha Wealth is to help you find the right balance, and typically to help you apportion your monies correctly. But there is a place for both. EIS is likely to last until next year, so you've really got this year and possibly next to benefit from that. Pensions are obviously going to continue indefinitely. And as I say, it's about just, really speaking to an independent broker like Alpha Wealth and making sure that you have the right balance.
So somebody has just put in a question there and said they love the idea of pensions, but their fear is locking up the money without access to it for decades. This person is in their 30s. So their question is there a way to leverage their pension fund to get a loan if there is an emergency?
No, is the short answer. However, pensions can be accessed from age 50 onwards. And this is where it goes back to having different pension pots that would allow you access if there was a requirement. So some people, for example, may have a pension from a previous employment, and we help them understand and manage that pension scheme and explain to them that at 50, they may be able to draw all or a large portion of that out tax-free. And it's good to know that as part of your overall financial plan. You may have children that maybe you haven't sufficiently funded for third level. There may be an opportunity for you to obviously get access to that monies. But in that instance, my advice is get a proper financial plan. We have a financial budgeter, which is the starting point for anybody. Understand what you can afford to contribute, knowing that you can change your pension contribution at any stage. But any money you put into a pension, it's not available until 50. But you shouldn't need to access it. The whole key of the pension is it's about obviously, providing you that ability to fund from 50 years of age onwards.
And if you are moving a portion of your bonus to your pension via the company paying it, does this affect the maximum contribution and that you can actually put in?
It doesn't, because your pension payment in terms of those figures I spoke about earlier. So I'm going to use myself for example, 49 years of age, I'm in the 25% category. I'm actually turning 50 later this year, and that means in this year, I don't have to wait until I'm 50, I can go up to the 30% category, but not to confuse you. That's based on my basic salary. So if I can use a bonus, it doesn't affect that at all. And as well as that, one thing people must remember, you are capped at a salary figure of 115,000 for pension purposes. So some of our clients who are earning more than 115,000 a year, they may think that they're maximizing their pension. But if you're not, if you're earning over that, you need to put in more money than you may consider through the ABC system. And again, we can explain the nuance of that. But my advice, guys, is if you can pay a bonus into your pension, you'd be mad not to consider it. The taxman's catching you for 52% of it, put it into your pension, you don't pay him a cent. Just to move on from that, this is specifically more geared towards company owners and directors of companies. We talk about more tax efficient mechanisms. I've spoken about pensions, but there are others. As a business owner myself, I don't pay for any protection policies other than a mortgage protection plan. And the reason I don't is that my company pay for them and my company benefits from tax relief on those payments. It's really important to understand this. And I say to anybody who is a director or a business owner, you really need to look at your own situation in terms of what you're paying for and whether it can be provided by your company. I come across a lot of people who are covered very significantly, even senior managers through their company, and have a lot of personal insurance that I think they're overpaying for. It's overexposure and it's not really necessary. For business owners also, we talk about exit planning, and there's a lot of advice we can give to you around things like succession planning. A lot of my clients have kids and they have, I suppose, monies where you may or may not realize this, but we can only gift, or our kids can inherit up to 335,000 per child. And that may seem like maybe a lot of money that you can give a child, but if you're leaving them at home, it's going to far exceed that typically. So we help our clients understand about how you can start to plan effectively. And that's without the use of accountants, very simple mechanisms there. Specifically for business owners, my advice to any business owner listening to this is that you should be aware of what's called entrepreneurial relief and retirement relief. And if you're not, and I'm not going to go into detail today, please reach out to me and I'll explain them to you very briefly about how you can get money out of your business very tax effectively outside of the use of a pension. The other thing is for business owners, how you can attract and retain staff. We have a pension scheme inside Alpha Wealth for employees. We have income protection and death in service. I say to any companies, 3 people or more, it's a very simple, low cost benefit to staff. And it's something that you should again consider. I'm a great believer of get information and make an informed decision. You may or may not want to affect something, but the fact is it's understanding what you can do and make sure that you take advantage of this. Finally, on this topic, I'm just going to talk about benefit in kind. Obviously, for some people who have a company car and understand since January, the cost of a company car has gone up extensively through benefit in kind. Again, I won't go into massive detail with you, but it's based on the CO2 emissions and the kilometers that you do. And really, I know these are very simple things and suggestions, but my advice generally to anyone who has a company car is, can you give back the car and take the car cash allowance instead? It will generally work out better for you. Obviously, if you are changing cars, perhaps consider going for a cheaper car, one with lower emissions. Can you do more than the 48,000 kilometers, which is the maximum amount that you can do? And then finally, can you get a commercial vehicle? A friend of mine has a very similar car that I had, which is a Discovery, but he has a 2-seater as opposed to 4-seater, plus it's commercial and he pays no BIK on it. Just before we get into any further questions, the final webinar that I mentioned, as I said, my colleague David Looney is doing this next Tuesday at 1 p.m, the 23rd of May. Again, it will be on video for anyone who is listening to this after the 23rd of May. It would be worthwhile. Dave's going to talk a little bit more detail about taking advantage of the tax opportunities that are available to all of us. Just finally then, in relation to Alpha Wealth and our role, and people often ask me, what are the fees? Specifically, for anyone who listens to one of our webinars, we are currently offering up to the end of June a discounted fee of €99 for a full financial consultation which takes an hour. We just ask for some preliminary information before the review. We can do it in person, in Cork, possibly in Dublin also. We have a small presence in Dublin, but primarily on Zoom at a time and day that suits you with a partner if it's relevant. And we will give you a full overview as to where you are currently, how you can save money, and how you can plan effectively in the future. So on that, I'm just going to pass you back to my colleague Cleena, and I do appreciate you listening in today. My colleague Keenan has put in details of how you can access the financial review and also a little bit of information on EAAS and the webinars, both previous ones and the one that David is doing next Tuesday. Thank you.
Thanks, Nick. So can I just ask you what your thoughts are on self-administered property pensions?
So this is an opportunity for anybody who has a pension scheme, perhaps from previous employment or in their current employment, that if they leave their current employment with a pension of 200,000 euros or more, one of the options for them is to potentially move it into a pension where they can buy an asset, typically, let's say, a property. It's something I've done for many clients. I think it's a very worthwhile opportunity to understand it as an option. The reason being is that if you buy a property in your pension, you benefit from getting the rental income tax-free. If you sell that property for a profit, you do not pay capital gains. And it certainly would be more beneficial, in my view, than having an investment property personally, where you're getting hit for tax of 52% typically on the rent. And obviously, any profit that you make on it, you're also going to pay capital gains tax. So, I am in favor of it, but the key thing is, do you have a pension of that magnitude? And you can't typically use a current pension scheme where you're employed by a company like Google or Amazon or whoever. They're not going to allow you to set this up in its current guise.
So let's say, for anybody here, let's say that invests in the EAAS scheme and they get their return after, let's say, 5 years. Can they put that return then directly into their pension? Or do they have to pay capital gains tax?
So I'm going to go back to that example of 10,000 euros and say to you that if, let's say, you did that 4 or 5 years ago and you got your 4,000 back early and that you've got back your 12,800, the 28% return is subject to capital gains tax. We have an allowance each year, all of us, of 1,270. And if you're not selling shares every year, you could offset that against the 2,800 gain. Yes, of course, you can put that money into a pension, as I've described it, if you're not maximizing your pension in that year, and get 40% relief on it. So you get a double benefit from that. It's a win-win. As well as that, anyone who has shares in their company, my advice always is to sell the shares. You'll end up with too much exposure to those shares in that one company. You're not taking advantage of your annual allowance of 1,270. You should absolutely sell shares every year. Try not to be too discursive about share price. I tell people to do it on a yearly basis, and therefore it takes the risk of when you sell out of the equation. But if you think about it, if you've got 10,000 in your shares in your company, whether it be Gilead, Amazon, whoever it is, and you can sell those shares, hopefully at a profit, small bit of capital gains to pay on those, and put that money into an EIS, get 40% back, wait 4 or 5 years, get the money back from the EIS, and then bang it back into your pension. Like, it's a fantastic opportunity. But as I said, we can help you understand the benefits and help you find the right balance in terms of your own personal situation.
And can you exit from the EIS early?
One of the drawbacks of EAAS is that you have no control as to when that money is returned. You do have rights over your investment insofar as you get a form of share. It's not ordinary shares, it's a B class of shares. That if the company doesn't pay you back, there is a legal agreement that sits behind that. You convert to an ordinary shareholder, you therefore have rights in the ownership of the company. But the sale of the EIS scheme is on discretion of the company. Now, the company will always want to work with you, of course. They will have to keep the money for 4 years to qualify for the relief, but they would typically sell out in years 4 to 5. The only downside of EIS, in my mind, is that if they're not in a position to pay you back, you may have to wait a further 6, 12, 18, 24 months. But the gain that it allows you, and the fact that you're looking to get a benefit, I think it's definitely worthwhile for people who have a high income and money sitting in the bank as an opportunity, as part of their overall portfolio.
And just in the interest of time, maybe you could finish by just outlining what are the fees associated with EIIS, and I suppose for anybody, Nick, that wants to engage with you following the webinar, how to make contact with you to book a review. Thank you.
No problem, thanks. So typically the fees for EIIS vary from 1 to 3%, depending on the company. So 2 companies that I've referenced earlier, Blacks, there's a 2% fee, you put in 10,000, the total cost to you, and the only cost is €200. With 2 Mile, which is the restaurant in East Cork, it's 1%, so it's €100 and 10,000. With respect to contacting us, the easiest way to get us is email us directly. Myself, nick@alphawealth.ie, which is on the screen there. Ring me on my mobile if you wish. We're available, obviously, to talk. And if anyone has any questions, perhaps that they haven't asked today, or if you're listening to this on playback and you have a query, just email us. We're not going to charge you for any questions you ask us. That consultation fee of €99, which Keenan's put into the chat, that is the once-off fee. There are no further fees or charges for you to engage with us. And the purpose of that fee is basically for us to put together that financial summary for you and show you how you can make money. And I think it's really a worthwhile exercise for people. And if you're not sure about, Alpha Wealth and maybe engaging with a financial advisor, just go onto our website, read some of the reviews. We are on Trustpilot. You can ask me for recommendations. Pretty much worked with most companies at this stage in the 25 years that I've been a financial planner, and I'm fairly certain I can get you a review or a recommendation from somebody you probably know. Ireland's a very small place, and 6 degrees and all that. So as I say, please do reach out to us, and we really would love to try and help in whatever manner we can. However, insignificant you feel the question might be, or simple, there's no, easy questions. Please just ask us.